Bloomberg Audio Studios.
Podcasts, radio, news.
Let's get back to the inflation print out of the US and what it tells us about thinking from the Federal Reserve. Underlying US inflation then topping forecasts, as I mentioned, of course, for a second month in February. The advance likely to reinforce the Fed's cautious approach to cutting rates. Very pleased to say, joining me now is Randall Kroszner, former Fed governor and professor of economics at University of Chicago's Booth School of Business. Randy, great to have you in the studio to digest this number.
Sure.
What stood out to you? Is this a sticky inflation print that we're seeing in the US, or is it a more entrenched inflationary picture that causes potentially a challenge for this Federal Reserve?
And that's exactly what the Fed is trying to pull apart, and that's why Jay Powell said he wanted to see a little bit more data before coming to a definitive conclusion of when they can move. Now, they usually focus on the so-called personal consumption expenditure index, not the CPI. The PCE is a little bit better balanced in terms of the role of mortgages, or I should say the role of different parts of the consumer basket, and so they prefer that one. But this still is suggestive, and I think will give people pause. Certainly, no one's, I think, going to be moving in the next week, but they may leave the foundation for a move in June.
Okay, before we get on to your views on where they land and the sequencing, you say it's possibly June. In terms of unpacking the basket of inflation that we got through yesterday, with all the context, as you say, that the focus is really going to be on PCE for the Fed, we did see goods inflation ticking up a little bit. That seemed to be something of a surprise. Do you expect that to be short-lived, or is that indicative of a more concerning trend?
So I think the goods are going to be more volatile, because that's going to be more energy and commodity prices that sort of move up more up and down. And so that's why they tend to look at core that strips that out. But we're still seeing fairly strong growth in services. And in particular, still strong wage growth. Now that's great for workers, but more of a challenge for the Fed.
And you mentioned Jay Powell, and he said, of course, in testimony last week that we are getting closer. He wants more confidence. Him and the FOMC, they want more confidence in terms of the data that they're seeing before they act, before they cut rates. But he says we are getting close. I just wonder if there's a concern that he may have to walk that back. It seemed to be relatively dovish from Jay Powell. Are you concerned that he may have to walk that back, given what we're seeing on the data front?
Well, so far, I don't think there's enough data there to say that he's going to have to walk that back. But he's made it very clear he needs to see more data before moving. And so if the data don't move in his direction, I think he doesn't have to walk anything back. He can just say, we haven't seen the data yet to be able to make that move.
Okay. We're looking, of course, for the forecast, the updated forecast from the Federal Reserve, or the dot plots and the potential revisions there. The markets, of course, have gone from the start of this year pricing at about 7 cuts to a little over 3 right now. How do you expect the revisions to the dot plots to evolve? What are you expecting to see from that?
So I don't think we're going to see dramatic revision to the dot plots. I think the markets have finally gotten it. I thought it was just sort of crazy that they were thinking that there are going to be so many cuts at the beginning of the year. And I think the Fed has been fairly consistent in their message. And finally, the markets are starting to move to be roughly where they are. I don't see that the data has changed so much that would dramatically change the dot plots. I think 3 seems to be roughly right. The question is, will they start in June or maybe start a little bit later?
Okay, so 3 seems relatively reasonable. Where are you in terms of your views on the US economy? Jamie Dimon, a big line crossing this week when he said, look, we shouldn't write off the risks of a recession. It is still potentially in the cards for the US, after almost kind of consensus view amongst the guests we speak to that soft landing is there now for the US. Where do you land on this debate?
Where do I land? So, there's soft landing, hard landing, softish landing. I'm kind of hardish landing. Okay. That is that I do think that there'll be a substantial slowdown in the second half of the year. Now, why is that? Because real interest rates have finally gotten positive for the first time in 20 years. They've only been positive for about 6 months. That is the interest rate, the 5% or so interest rate, has been above the inflation rate only for about 6 months. Real wages are finally starting to grow in a positive way. Now, remember, when prices were going up at like 8%, you could sell stuff at 8%. Your main input cost was going up at 3 or 4%. That's a great trade. You're going to buy a lot of that input. When real wages start to grow up a little bit more, and you're not being able to sell at quite the same pace or same pace of price increases, you may start to see a little bit of weakness in the labor market. I'm not calling for recession, but I think a slowdown from where we are. We've been just having screaming growth in the U.S. I don't see how that's going to quite keep in the second half of the year.
That pricing power then ties into the story around equities and around what we're seeing in terms of stocks. Does that suggest that stocks are getting a bit ahead of themselves then? If you see a more challenging picture in the second half, does this rally in US stocks look a little unsustainable to you?
Well, I'm usually not in the business of predicting the exact level of the stock market, but I do think that markets seem to be kind of priced to perfection. They seem to be thinking that, a soft landing or no landing at all. We're going to continue to have really strong earnings growth. I'm a little bit more concerned that there could be some challenges to that.
You've been also thinking, I know, in great detail about the proposals around additional capital reserves for the US banking system. And this also caused some surprise and certainly generated headlines when Jay Powell suggested that the proposals would be either radically revised, rewritten, or potentially scrapped altogether. You've been thinking about the potential risks of this proposal. Give us the detail on why you think actually the proposals, if they were to come into force, they could actually cause more risk for this financial system versus reducing the risk.
Yeah, because I don't think there's been a really careful cost-benefit analysis that's done. Certainly you want to make the banking system safe, but you also want to make the entire financial system safe. So if you keep raising capital requirements, what happens? More and more activity goes outside of the banking system. And we've been seeing that, whether it's private equity coming in and doing private debt, so many other areas that you're seeing a lot of stuff going off into the so-called shadows. There's potentially more risk there because the regulators as well as market participants don't have as much line of sight. And that's where you could potentially get these unintended consequences of, sure, you're trying to make the bank safer, but you could maybe make the entire system a little bit more risky.
Is that where the regulatory lens needs to be then, on the off-balance sheet banking sector, the shadow banking? And how concerned are you that potentially there's a black swan event there?
So I think that's where we really need to have a stronger line of sight. We need to do more data gathering there. We need to have better understanding of the risks of interlinkages amongst those non-banks as well as between the non-bank sector and the banking sector. I think that's really where we need to have a lot more focus.
Randy, I was speaking to a former BOJ official yesterday, and he said the likelihood for him of the BOJ going next week with a rate hike, the first one since 2007, he put that at 70%, and he also suggested they could also drop yield curve control. Where do you think the BOJ goes next week? Do you think they've seen enough to give them the confidence to make this move?
So I think Ueda-san wants to go very, very gradually, and I think that's the kind of mantra that he's had so far. They're facing a lot of challenges because obviously, as you said, there's very strong wage growth, not only at Toyota, but a number of the other wage settlements have been very, very strong. But they're also in a period of very low GDP growth, and also inflation expectations haven't quite moved up to the 2% area where they want them to be. So I think they'll move cautiously. There may be some slight moves in the direction of a move up next week, but I think it's more that they're going to provide the foundation for moving down the line. But I think they need to see a little bit more to make sure that consumption is still going to be strong and inflation expectations move up.
And when you say down the line, you think April, or do you think they could even push it further back?
I think it'll depend. I mean, we're seeing some weak economic numbers overall. If those turn around, then I think they'll move more rapidly. If those are still quite weak and we still don't see inflation expectations moving up, it could be a little bit later. But I think there'll be gradual moves in each of these steps in that direction.
Okay, cautious, gradual, the timing still TBD. Are global markets ready for this shift from the Bank of Japan? What do you expect to see in terms of the global market ramifications of this move?
Now, this is something that's very important. Japan is a very big place, and Japan has a lot of debt outstanding. And so obviously as interest rates go up there's going to be more flow back to Japan. Most major countries of the world are issuing a lot of debt, and so there's going to be a lot of competition for who's going to buy which debt. So far, the bond vigilantes haven't come back out. They seem to be happy to say, oh, lots of debt, no problem. At some point, they will rise up. I hope it doesn't come too suddenly, but at some point, they'll come back, and that's going to be a problem.
Has that surprised you, that the bond vigilantes are so far stood on the sidelines? And what do you think would be the trigger then for that intervention?
That's always the key. We never know exactly what triggers it. Something changes people's confidence. And look at countries like Argentina. They kind of go along very well for a while, and then boom, suddenly something happens and people get very worried. Is the rest of the world like Argentina? No, but you worry that there could be some sort of triggering event that make people say, gosh, I'm not so sure they're going to be repaying, or I'm not so sure they're going to have the economic growth to be able to make those payments.
On the ECB, a couple of dovish comments today suggesting maybe from the Bank of Governor over in France and another central bank governor who sits, of course, on the ECB Governing Council, suggesting that possibly April, possibly June. There's a debate as to whether the ECB has to wait for the Fed to go first. Is the ECB, though, given the dynamics in terms of softer inflation versus the US and a much weaker economy than the US, is the ECB at risk of a policy mistake?
So I think they have much more pressure to move more rapidly because, exactly as you said, much weaker economy, and the U.S. economy is still quite strong. And so I think they're going to get pressure to move more rapidly. But I think they are looking very much at what the Fed is going to do. And so I think how the Fed characterizes what their next move is going to be, because my guess is the Fed's statement next week, they're not going to say they're going to move, but they're probably going to say they'll move soon, leaving the foundation for moving in June or next move in the summertime.
Okay, the gravitational pull of the Fed, always.
Yes.
Randall Kroszner, thank you very much indeed for the analysis of coming on, of course, into the studio to walk through that CPI print, the implications for the Fed, and of course, where the BOJ and the ECB could go as well as they weigh up their own challenges. Randall Kroszner, former Fed governor, of course, and professor of economics at the University of Chicago.